Good morning, everybody. This is Patrick MontesDeOca here with a live trading room at the Equity Management Academy. The purpose of this podcast is to simply educate you and to coach you and teach you in a very transparent way, the way that we analyze and that we basically apply the intelligence that we use to trade live here in the trading room for the purposes of subscribers that are self-directed individuals that basically want to use a program, a system that gives them very high probabilities of success because nothing really is for sure when you're trading in these markets, and you have to be aware, obviously, that there is a risk involved when you're trading financial instruments, when you're trading futures, when you're trading particularly leveraged instruments. There is a high level of risk, and you have to act accordingly. But according to the intelligence that we use, the chart here that we're looking at is the price of gold. In what has happened in the gold market in 2016. What we're looking at here is the price of gold bottomed in November the 30th of 2015 at about 1,045.40 an ounce. And this was during the announcement of the Federal Reserve raising interest rates 25 basis points for the first time in about 10 years. It created a bottom in the gold market that basically brought the price to about $13.78 by July the 11th. In about 6 months, in 2016, we saw $13.78. And that was about 180 days, or the top came in using the 180-day cycle that we use in trying to identify the extremes above the mean in price or the extremes below the mean. Since the high was made of 1378, what we have seen is, first of all, the validation and confirmation that this first rally that we saw was leg number one in what appears to be a much bigger wave pattern that projects some very, very significant in higher numbers, in higher prices. But since the high was made of 1378, we have come down all the way almost to a 78.6% Fibonacci correction. And the majority of the times when the market comes down into this level, it usually signifies the completion of this pattern. And the closer that you can buy into that 78.6% retracement, the lower the risk, because your stop, your level of protection is 1116. If this closes below 1116, then this leg will be negated completely, and it would go neutral. And then we would have to see what happens down here that would give us another indication of where the market is going to go in this pattern. But so far, what we're seeing is simply a correction into a perfect alignment, into a 78.6 potential retracement that essentially coincides, and this is where the work that we do becomes extremely valuable, because when we apply the information that we use, the algorithms that we use, this identifies for us in color the demand area, and very specific, it gives us a daily price level that is activated when the price action reaches these levels. And so in taking a look at the weekly chart, the price level coming down to these levels here is activating a setup, okay? And when it touches this price level, and it's touching right now the 1129, it's a setup, and it tells you basically where the price action or the price level is trading at in relation to the demand level. And in using the reversion to the mean, these levels here, or the 78.6% level of 1116.70, are the highest probabilities for a market reversal. Because if it closes below there, once again, this whole pattern previously made will be negated. I will continue to update you more closely here and following through this pattern, because I believe that we are in a very critical period and time in the price of gold and silver. This is Patrick MontesDeOca. Thank you for allowing me to share this information with you. Until next time, my friends, be well. Good trading. Take care.